Hey folks, Jerry Romine here, diving into the world of stock options without the fluff. This video will leave you revved up for our next lesson on married puts. Fasten your seatbelts, we're about to make options easy and fun. Welcome to the world where making money doesn't always mean buying low and selling high. Today's spotlight, the covered call. Imagine owning shares and earning extra by selling someone the option to buy your shares at a set price. It's like renting out your stocks while you wait for their value to rise. Simple, right? Let's break it down further. A covered call happens when you own shares, that's what your cover is, and sell call options on the same stock. Think of it as a strategy for the cautious optimist. You're happy to keep your stock but wouldn't mind making some cash on the side while you wait for a slight price bump. It's the investor's way of saying, I'm optimistic, but let's be real about how high this stock will go. Let's talk numbers without making your head spin. You own a stock at $10, you sell a call option for a $1 premium with a $20 strike price. Best case scenario, you pocket that $1 premium and your stock climbs up to $20. That's an extra $11 per share. Worst case, your stock dives, but hey, you've got that $1 premium as a small consolation. So when's the time for a perfect covered call? When you believe your stock will chill at its current price or go up in value but not past the covered call strike price you sell. It's like betting your stock won't be the life of the party but won't sit in the corner either. However, if you're expecting your stock to skyrocket, then covered calls might not be a good fit for that stock because your profits are capped at the strike price if executed. And for those diving deeper into investing, I give real-time trade alerts in my Patreon, and if you'd like to try my TradingView custom indicators, there's a free trial link in the description below. With that out of the way, let's go over an example. Imagine our fictional stock, Jerry's Gyms, trading at a comfortable $25. You're holding tight, expecting mild waves rather than a tsunami. You write a covered call with a $27 strike price, pocketing a neat 75-cent premium per share. If Jerry's Gym stays under $27, you're the champ, keeping your premium and shares. But if it skyrockets, your profit stops at $27. Still, not a bad day's work. So are covered calls the golden ticket? They can be a savvy move for the conservative investor looking for a bit of extra cash without too much drama. Remember, the goal isn't to gamble, but to invest wisely, using strategies that align with your expectations and risk tolerance. First off, options trading. It's like being given the keys to a potentially lucrative kingdom, but with great power comes great responsibility. Options are contracts that offer the right but not the obligation to buy or sell a stock at a specific price on or before a certain date. Now, while options can turbocharge your portfolio, they can also be a quick way to lose money if you're not careful. That's where strategies like the married put come into play, providing a safety net as you learn the ropes. What is a married put? Picture this, you've just bought shares of your favorite stock, dreaming of the profits you might make, but the stock market can be unpredictable, like weather in the mountains. A married put is your insurance policy, ensuring that even if the stock price falls off a cliff, you won't lose your shirt. You purchase a put option for the same stock, which allows you to sell your shares at a predetermined price, no matter how far the actual price may fall. It's like having an extra parachute when you're skydiving. You hope you won't need it, but you're glad it's there just in case. And for those diving deeper into investing, I give real-time trade alerts in my Patreon, and if you would like to try my TradingView custom indicators, there's a free trial link in the description below. With that out of the way, let's go over an example. Let's roll up our sleeves and look at a practical example. Suppose you buy 100 shares of a company called Future Tech at $50 each. To protect your investment, you also buy a put option with a strike price of $45, paying a premium of $2 per share. Now, if Future Tech stock takes a nosedive to $40, your put option allows you to sell at $45, significantly reducing your loss. This strategy is about minimizing risks and keeping your investment journey on a steady course. The million-dollar question, when do you play this card? A married put is ideal when you're bullish on a stock but nervous about short-term risks, perhaps due to market volatility or an upcoming announcement like earnings. It's particularly appealing for stocks you believe in long-term but are riding through a rocky patch. This strategy ensures you're part of the stock's upside while being shielded from the worst of its downturns. Every insurance policy comes with a premium, and married puts are no different. The cost of the put option eats into your potential profits, making it crucial to assess whether the protection it offers is worth the price. It's about finding that sweet spot where the cost of the put aligns with the level of risk you're willing to accept. Remember, investing is as much about managing risks as it is about seeking returns. Is a married put right for you? Incorporating married puts into your investment strategy signals a thoughtful approach to risk management. It's suited for investors who are venturing into options trading with an eye on long-term growth, providing a safeguard against the market's ups and downs. As you become more comfortable and experienced, you'll learn when to employ this strategy to its best advantage, balancing protection with potential. Option spreads can seem like a complicated dance of buying and selling, but think of them as your strategic moves in the options trading game. Both credit and debit spreads are about making these moves with precision and strategy, aimed at maximizing your gains or minimizing your losses. Imagine you're a general plotting your next move. That's what setting up a credit spread feels like. It involves selling a high premium option while simultaneously buying a lower premium option. The magic happens because you collect more premium from the option you sell than what you pay for the one you buy, resulting in a credit to your account. For example, you sell a call option with a strike price of $40 for $1. You've just netted a cool $200, setting the stage for potential profits if the spreads between these options narrow. On the flip side, let's say you're more of a treasure hunter, seeking to uncover value with a bit of an upfront investment. This is where debit spreads shine. You buy an option that costs more upfront and sell another for less, spending a bit of cash or debit from your account in the hopes that your chosen direction will pay off handsomely. For instance, buying a put option for $5 and selling another put option for $1 means you're betting $400 on a strategic move. If the market plays in your favor, this can lead to significant gains with limited risk. Deciding between a credit or debit spread is like choosing the right tool for the job. Credit spreads are your go-to in volatile markets, allowing you to collect premiums and possibly benefit from time decay. Debit spreads, however, are best when you expect moderate moves in the market, letting you capitalize on directional bets with limited risk. I personally prefer credit spreads because you get paid when you open the position, and if you do them right, you're profitable if the markets are flat, move in your direction, or even move against you a little bit. And for those diving deeper into investing, I give real-time trade alerts in my Patreon, and if you'd like to try my TradingView custom indicators, there's a free trial link in the description below. With that out of the way, let's go over an example. Let's bring this home with a fictional example. We have two stocks, AlphaTech and BetaWorks. AlphaTech is booming and you expect it to rise. You might implement a bullish credit spread by selling a high premium call and buying a lower premium call. On the other hand, if you believe BetaWorks is set for a slight dip, a debit spread by buying a high premium put and selling a lower premium put might be your best bet. The straddle is your options trading Swiss Army knife. Imagine you're gearing up for a big football game. You're not sure if it'll rain, bringing a muddy slip and slide fest, or if it'll be clear skies, perfect for a passing game. In the stock market, a straddle is akin to preparing for both outcomes. It involves simultaneously purchasing a put and a call option on the same stock at the same strike price and expiring at the same time. This dual action move is like having tickets to both potential plays, ensuring you're set to capitalize whether the market's mood swings high or dives low. To truly understand a straddle, let's break it down. A call option is your bet on the stock rising. It gives you the right to buy at a certain price. Conversely, a put option is your hedge against a fall, offering the right to sell. When you straddle, you're essentially saying, market, do your worst or best, I'm ready either way. It's a powerful statement in the unpredictable world of stocks, embodying the essence of being prepared for all eventualities. A straddle is the strategy for an indecisive market. Ever watched the market and thought, it's too quiet, something's brewing? That's your cue for a straddle. This strategy thrives on anticipated market tremors, be it due to earnings reports, product launches, or regulatory shakeups. When you sense a big move but can't peg it as good or bad, a straddle allows you to play both sides, ensuring you're in a position to profit from volatility, the lifeblood of options trading. A well-placed straddle isn't just a shot in the dark, it's a calculated move. It involves keen market observation, understanding potential triggers for volatility, and acting before the wave hits. This proactive stance can transform uncertainty into opportunity, turning the market's mood swings into potential profit stream. Let's dive into the nitty-gritty of building your straddle. Picture a stock, let's call it Tech Genius, currently at $100 per share. With a major product announcement on the horizon, you foresee volatility but can't predict which direction. You decide to buy both a put and a call option at a $100 strike price, expiring in a month. If each option costs $5, your total investment is $10. This premium is your ticket to the volatility feast, and the objective is clear. Tech Genius needs to make a significant move in either direction to cover this cost and then some. And for those diving deeper into investing, I give real-time trade alerts in my Patreon, and if you'd like to try my TradingView custom indicators, there's a free trial link in the description below. With that out of the way, let's go over an example. Investing $10 in a straddle means you need Tech Genius to swing beyond just covering this cost. If it jumps to $115 or drops to $85, you're in profit territory. This isn't about modest gains, it's about leveraging major movements for significant returns. The beauty of a straddle lies in its flexibility, allowing you to profit from market dynamics while managing the inherent risk of options trading. The moment of truth in a straddle strategy hinges on the stock's performance. If Tech Genius merely wobbles around the $100 mark, the premiums you've paid might as well be tickets to a show where the band never shows up. However, if it either soars with innovation or stumbles over a scandal, you're set to potentially rake in nice gains. This is where your market insight paired with a well-timed straddle can shine, turning volatility from a foe into a friend. Now visualize Tech Genius defying expectations, rocketing to $120 post-announcement. Your call option is in the limelight, significantly outweighing the put option's loss. Conversely, if it tanks to $80 amid disappointment, your put option becomes the star performer. This dynamic interplay underscores the straddle's essence. It's not about betting on a direction, but betting on a big movement itself. No strategy is without its pitfalls, and straddles are no exception. The key challenge? Ensuring the stock's movement is sharp enough to surpass the premiums paid. Markets that tease with slight moves but never fully commit to a direction can erode the straddle's position, leaving traders with a less than stellar outcome. It underscores the importance of strategic selection and timing in deploying this versatile yet nuanced strategy. Mastering straddles is akin to becoming a maestro of market moods. It involves a deep dive into market indicators, understanding the catalyst for volatility, and importantly, knowing when to step back. A well-timed straddle can be a symphony of strategic prowess. Mistimed, it can be a costly lesson in market humility. A strangle strategy might sound complicated, but it's pretty simple once you get the hang of it. Imagine you're at a crossroads, unsure which path to take, but you know for sure that staying put isn't an option. That's where the strangle strategy shines in options trading. You're playing both sides of the field, betting on significant movement without worrying about the direction. We're talking about buying a call and put option on the same underlying asset with different strike prices but the same expiration date. Let's cover a long strangle, which is what I call the adventurer's choice. Let's say you're feeling adventurous and decide to go long with your strangle. This means you'll buy an out-of-the-money call, hoping the asset will climb, and an out-of-the-money put, hedging your bet if it falls. The beauty? Your profit potential is unlimited if the asset decides to sprint in either direction, making it an exciting strategy for those who believe big news or market moves are on the horizon. Now, a short strangle or playing it safe-ish. Not everyone likes living on the edge though. For a more reserved approach, there's the short strangle, where you sell both an out-of-the-money call and put. This strategy bets on the market chilling within a range, offering profit from premiums as long as the asset doesn't break out from its comfort zone. It's a bit like collecting toll fees on a quiet highway. Less thrilling, but money is money. And for those diving deeper into investing, I give real-time trade alerts in my Patreon, and if you'd like to try my TradingView custom indicators, there's a free trial in the description below. With that out of the way, let's go over an example. Imagine Starbucks. Let's call it Cafe Bucks in our fictional world. It's trading at $50. By executing a long strangle, you buy a $52 call and a $48 put, both expiring next month. If Cafe Bucks either skyrockets due to a revolutionary latte launch or plummets because of an espresso scandal, you're set to make significant profits, provided the move is strong enough to cover your initial costs. This strategy is about catching big waves, not paddling in the kiddie pool. Calculating your break-even, the path to profit. Navigating the strangle strategy means knowing your break-even points. It's simple math. Add your total premium spent to the call strike for the upside break-even and subtract it from the put strike for the downside. Your mission? Hope for a move beyond these markers. Mastering the strangle is the beginning. As we wrap up, remember, the goal here isn't to just understand, but to use these strategies to navigate the markets with confidence. Next time, we'll explore the iron condor, another fantastic beast in the option strategy zoo, offering insights for seasoned traders and newcomers alike. Stay tuned, stay curious, and always happy trading. Let's start with the basics. An iron condor is a strategy in options trading where you use 4 different options to capture profit from a stock or asset that's not expected to move much. It's like setting up a net to catch profits, whether the market moves up a little or down a little. The beauty of it, you limit your risks while setting clear boundaries for where you make your money. Constructing an iron condor might sound like you need an engineering degree, but it's actually straightforward. You sell a call and put option at the middle strike prices close to the current price of the stock. Then you buy a call and a put option further out to cap your losses. It's a balancing act, ensuring your losses are controlled while opening up for profits in a stable market. Now, how do we make money and what's our risk? Your max profit is the premium you get from setting up the trade. It's your reward for being the middleman. The catch, your potential loss is capped too, but it's there. It all boils down to the stock staying within your chosen range. If it does, you're in profit territory. If not, well, you've got your losses limited by those extra options you bought. And for those diving deeper into investing, I give real-time alerts in my Patreon, and if you'd like to try my TradingView custom indicators, there's a free trial link in the description below. With that out of the way, let's go over an example. Imagine you're looking at a stock, let's call it Future Tech, currently priced at $100. You think it's not going to move much. You set up your iron condor around the belief, choosing strike prices and collecting premiums up front. If Future Tech stays between your strike prices until expiration, you keep those premiums as profit. It's like placing a bet on stability with the odds in your favor. First off, a butterfly spread is like the Swiss Army knife of option strategies. It combines the power of bull and bear spreads into one, offering a safety net with fixed risks and capped profits. Ideal for those who prefer a market-neutral stance. This strategy shines brightest when the underlying asset remains stable. At its core, the butterfly spread involves 4 options and 3 different strike prices. Picture this, 2 wings and a body where the body is at the money and the wings are equidistant from this central point. Whether you're playing with calls, puts, or a mix, the setup is designed to cater to your speculation on volatility or lack thereof. Now, let's savor the different flavors of butterfly spreads. First, the long call butterfly. Think of it as setting up a net where the maximum profit lands if the stock hovers around your at-the-money calls by expiration. It's like fishing for profits in a calm sea. Second, the short call butterfly. This one's a bit more daring, aiming for maximum profit when the stock price breaks free from our set boundaries. It's for those who like a bit of a chase. Next, we have the long put butterfly and short put butterfly, which mirror their counterparts but with puts. It's like choosing between skiing or snowboarding. Different tools, same exhilarating slope. And then we have the iron butterfly and reverse iron butterfly, which are the heavy metal of the group. Fine-tuned for specific volatility forecast, it's where you put your prediction skills to the ultimate test. And for those diving deeper into investing, I give real-time trade alerts in my Patreon, and if you'd like to try my TradingView custom indicators, there's a free trial link in the description below. With that out of the way, let's go over an example. Imagine Tech Innovations Corp, ticker TIC, is trading at a steady $60. Using a long call butterfly spread, we buy calls at $55 and $65 while selling calls at $60. If TIC stays around $60 by expiration, we're in profit city. But if it strays too far from $60, well, that's where our safety nets, the wings, minimize the fallout. The beauty of the butterfly spread lies in its balance. The risks and rewards are neatly packaged, with profits peaking when the market whispers rather than it shouts. But remember, commissions can nibble at your gains, so keep a keen eye on those. Let's kick things off with the basics. Imagine you're at a buffet, but instead of food, you've got a plethora of investment options. 2 dishes catch your eye: ETF options and index options. ETF options, much like a carefully crafted dish, are tied to an exchange-traded fund, trading like a stock throughout the day. Think of them as your gateway to investing in segments of the market with ease. Now, ETF options are the Swiss Army knife in your investment toolkit. Want to take a position on the entire tech sector or perhaps bet on the rise of emerging markets? ETF options have got you covered, allowing you to trade based on your market predictions. And the best part, they're as straightforward to buy and sell as your favorite stock, settling in actual shares of the ETF. Transitioning to index options. These are like betting on the outcome of the entire game rather than the individual players. With no direct trading on the underlying index, they offer a way to speculate on market trends or hedge your bets across a broad portfolio. Remember though, index options are settled in cash, making them a different beast from ETF options. And for those diving deeper into investing, I give real-time trade alerts in my Patreon, and if you'd like to try my TradingView custom indicators, there's a free trial link in the description below. With that out of the way, let's go over an example. Here's where the plot thickens. Unlike ETF options, which settle in shares and can be exercised at any point, index options are more like a gentleman's agreement, settling in cash when the time comes. This means no early exercises and surprises. It's a pivotal difference that can influence your strategy and how you manage your trades. As we venture into the crossroads, deciding between ETF and index options isn't about which is better, but which is right for you. Are you aiming for a straightforward trade with shares, or do you prefer the elegance of a cash settlement? Understanding the volume and liquidity of your options can also guide your path, ensuring your trades are as smooth as a good old bourbon. And there you have it, folks, a whirlwind tour through the landscapes of ETF and index options. Whether you're drawn to the tangible nature of ETFs or the strategic play of index options, the world is your oyster. And remember, our next journey will take us into the realm of option Greeks, where we'll unlock even more secrets to successful trading. So stay tuned, keep learning, and let's continue to grow together. Keep it real, and I'll see you in the next video.